So something I want to go in a little bit more detail on that I haven't really talked about in other videos is something called loan to value, and we have in essence talked about this, but I haven't exactly explained it. On Loan to value is going to apply on both refinances and purchases, and it's exactly what it is, the loan to value on the property. So earlier we were talking about doing a down payment of 5%. Which put us at a $237,500 loan amount, with the value or the purchase price at $250,000. So in this case, our loan to value would be 95%, just loan divided by value. Very easy calculation. But one thing we didn't talk about was, what if the house does appraise at $260,000? Well, what you would think is that value would jump to $260,000, and that would be the case in a refinance. However, on a purchase, the bank is going to actually look at the lower of the purchase price or the appraised value. So if the house appraises at 260, if our purchase price, if we agree that to the market that we're going to pay $250,000 on the property, then even though the value is 260, our loan amount is going to be based off of the 250,000. So on a conventional loan, or if you're putting 5% down, that amount would be based off of the 250,000. And the same thing with mortgage insurance, because mortgage insurance is going to be required. So if you're greater than 80%, if the LTV is greater than 80%, we're going to have some kind of mortgage insurance, or MI. And then the opposite is true, where if it's less than 80%, then we should not have to carry any mortgage insurance of any kind, and that changes depending on the loan amount. FHA loans, you'll have to carry mortgage insurance, but if less than 80%, but again on a purchase, that would have to be at 80% of the purchase price, not of the value of the property. That's a common question that I'll get. So that being said, going back to our offer and getting these closing costs paid for by the seller, if the house, so let's go back to the scenario. We've talked about doing a $255,000 offer and getting $5,000 towards closing costs, so we can get this paid for. But what if the house isn't worth $260? At the end of our last video, we said, okay, the house is only worth $250,000. Well, if it's worth $250, then this is 100% loan to value. Is going to, basically we're not going to be able, if we wrote an offer at $255,000, then our loan to value, so we're trying to base this loan amount, we'd be over 100%, and no bank is going to allow us to do that. So what we would then have to do is basically, even though they paid for the closing costs, we have to base this loan off of the $250,000. So if we're basing it off of the $250,000, the most loan that we could give is $237,500. This is our loan amount, and because we're basing it off of $250. So if we wrote it up this way, we wouldn't be able to borrow this much money. So we would, in essence, we would be short $242,250 minus $237,500. So we would be short $4,700. $4,750. So what we'd have to come in with on this offer, if the house appraised, so we have an appraisal at $250, you'd have to come to close with this, not only this amount, but then also this amount. So basically that comes out to $18,000. It's similar to where you're at right here. So the key thing in putting this offer in and getting your closing costs paid for is that the house has to appraise at that amount. So the next question is, well, what if it doesn't? Well, this is where we're going to get into interest rate and how we can basically finance the closing costs through the interest rate. So we're going to keep actually this example up here. And actually, what I'm going to do is I'm going to go ahead and recopy this offer 1. So we're going to recopy offer 1. So we're still the first offer we could do is offer 1, and this is a $250,000 offer with no money in closing costs. We're going to put $12,500 down, and resulting in a $237,500 loan amount. So cash to close is still going to be the same amount. We're going to come in with the 17,789. So 17,789. And in the past, what we've been talking about is the interest rate. And we've been using 4.5%. So that's what I'll use in this example as well. So we have a 4.5% interest rate, and that's where it's at the current market. So going back, we get an appraised value. So the appraisal for both of these has come in at, we'll say it's worth $250,000. So so going with this option here, right, offer 2, we can't finance in the closing costs. So you're still coming in with $18,000 at closing. Well, what if that's not comfortable for you, or if you don't have that money? We might not be able to do that. So so what we're going to do is write up another scenario here where we actually finance the closing costs through the interest rate. So this is going to be, we're going to do offer 3, right? So offer number 3, and this is going to basically say it's the same offer. So it's actually offer 1, but what we're going to do is structure the loan a little bit differently. So it's still going to be a $250,000 offer. We're not going to pay any closing costs, which results in $12,500 down. But what we want to do is the loan amount will still be the same. But what we want to do is try and offset these closing costs. So we weren't able to finance it through the purchase price, and if the seller won't budge on their price, then basically, we have to pay them $250,000. So so instead of doing this loan scenario where we come in with $18,000, let's actually raise the interest rate, and in exchange for a higher interest rate, we will actually get a credit towards closing costs. So to do another quick example over here, you've probably heard of paying points. Paying points is a pretty simple calculation, and it can be common. So we're gonna explain this very quickly here. So so at 4.5%, so say the market is currently at 4.5%. Well, 1 point, right? You could pay one point, which is 1% of the loan amount, which in this case would be $2,375. So you could pay 1 point, and in paying that point, you're going to get a 0.25% lower rate. And this isn't exact. The market is going to change every day, so we can't say that this is always going to be the trade-off, but typically it will be the trade-off. So so paying 1 point, we get a 4.25% interest rate, which is a lower payment, but it's going to cost us $2,375 at closing. And I'll go into this in very much detail in future videos, but this at least gives you kind of an idea of how exactly we're going to do this offer. So the opposite of paying points, right? The opposite of paying points is to basically to get a credit for your closing costs. So same type of thing, but basically we do it in reverse. So the market is at 4.5%, and what we want is money. We want cash to us. So we're going to take a 1 point. We're going to take a credit of $2,375. So this is a credit to us, and in exchange we're going to take a 0.25% higher interest rate. So we could go up to say 4.75%. Now interest rates are so low right now that that's still a super low rate, and really depending on when you're watching this, they might even be lower than that. But what that will do is result in a $2,375 credit to us at closing. So up here we were coming in with the 13,000 plus the 4750. And let's just go through all of our cash to close again here. 5% down would be the 12,500. If we scroll back up to our closing costs are still around this 5289. So 12,500 plus 5289. So we're going to add that in. So essentially the same. It's the same deal as here. But what then we're going to get is then a credit of $2,375. So even though we have the same $250 purchase price, basically our closing costs would be 12,000. Our money to close at closing, due at closing, is 12,500 plus 5289. But then you're going to subtract the 2375. So we're at 15,414. So 15,414. So this is our new cash to close, less than this, but what we take is a higher interest rate. So we're at 4.75. Now, if we want to get, and we'll talk about this more in detail in future videos, but if we want to get more money at closing, we could essentially bump this to 5%. And then get an additional credit of 2375. So, and these numbers are very general. They're not always this way. Plus, and I'll explain this in future videos. As you get higher in interest rate, it's harder to get the same percent credit. But this just shows you the flexibility. Also, with FHA loans, there's actually some more flexibility. Sometimes we can actually get bigger amounts credited to pay for your closing costs. So we'll sometimes use that to be able to get you in the house with the least amount of money out of your pocket. And all of these strategies just depends on your situation, the appraised value, the sales price, how much they're paying for closing costs. But the bottom line is, if you're communicating and letting us know and working with your realtor, you should be able to get back into the property, and getting into that property, we just stress this right here, in where it's comfortable for you, comfortable payment wise, comfortable funds to close, and all of the above.